Hello and welcome to the DIY Investing YouTube channel. We're going to dive into Accenture today. We're working through the entire S&P 500 doing 5-minute first looks. This is the first 5 minutes of my due diligence on a stock. And so I'd like you to follow along and understand my process by how I look at these companies. We're using quickfs.net. This is a great website to get a quick overview of a company before you're trying to dive into the investment. So let's first look at what I'm looking at. So we have Accenture PLC, ticker ACN. Market cap $225 billion, so this is a very large company. First thing I want to do is I want to understand the industry and the business. So Accenture Professional Services Company, they have a business description here. Provides strategy and consulting services, interactive technology and operation services worldwide. So immediately we know this is a consulting company. This is a services business. There's no products, they're selling services. And so they have a lot of different words in here talking about the services. They are also for cloud, ecosystem, marketing, supply chain management, basically consulting company. That's all you really need to know about the business. You're going to see the business look like a consulting company. So now, what do I want to learn about? What's nice about consulting companies is typically they are not asset heavy. They're going to be very expensive on operating expenses because they're going to be paying employees a lot, but they're not going to take a lot of assets. So you might see high returns, but let's see if that plays out. Now, beta. So I want to have as low a beta as possible, ideally below 1, but as low as possible. Because that means it's lower volatility, and that can tell you a lot about a business, even though I don't actually care about volatility. Beta is a useful measure. So we have beta higher than 1.16. Not great, but it's not super high. But it's just not meeting what I want here. But that's not a terrible thing. Share turnover, again, you want it as low as possible. Ideally below 50%. If it's 105%, you're turning over the entire share base every year. That means you don't have a lot of long-term investors. You don't have the ability for a strong builds-ups and price movements because the share turnover is high. Now, the next thing I care about is return on invested capital. I want it to be above 10%. So what do we have? For the last 20 years, every single year, return on invested capital is above 10%. This is great. Now, it's not very stable. You can see that from 2002, beginning at 17%, it increases to 59% in 2013, and then decreases again down to 26% in 2021. However, all of these numbers are acceptable. They meet the bare minimum of what I'm looking for. So let's turn to 10-year median returns. We see return on assets, 16.9%. Again, you want that number above 10%. Return on equity, 43%. Return on invested capital, 40%. Again, I like this number above 15%, and we're at 43%. So great, check mark. Everything's going well here. This is typical of good services businesses. You're going to see these high numbers because they don't take a lot of assets like a production company would. So 10-year median margins, what you're going to see on the other end is you're not going to have necessarily high margins. 30% gross margins is reasonable. What they're doing is they're making their money off of people and upselling people's time. And so you're going to be relatively low in assets, but relatively high in capital returns. So 10-year CAGR, we're growing revenue at 6%. And assets at 10%. It's typically not great that you're growing assets faster than revenue. This could lead to some opposite operating leverage, and that's kind of what you're seeing with the decreasing return on invested capital over time is as assets are growing faster than revenue, you're going to have that decreasing operating leverage. However, you do have earnings per share growing faster than revenue, so that's still good. Let's look at valuation. PE is 36.4. This is pretty high, but normal for high quality businesses in 2022. You have some very expensive companies. So again, I'm targeting less than 15. But this could perhaps work long term. We need to dive into some of the numbers here. So gross margins. If we look at gross margins for the last 10 years, 30, 30.2, 30.9, 30.4, 29.8, 29.5. This is very, very, very stable. What you can see here is they are not facing a lot of competition. They're basically pricing their services as a cost plus business above what they're paying for their employees. Very, very good sign. This is the sign of a high quality company. Their operating profit is likewise pretty stable, beginning at 13%, going up to 15%, but never dropping below 13% and staying very stable. Good sign for a high quality business. Now, earnings per share growth, it's not growing every year. You have some down years, but in general, the long-term trend is good and about above 15%, 10 to 15%. But I guess that 10-year CAGR is 10%. So again, you're paying out dividends. Those dividends are growing almost double digits. You start at $1.35 at the beginning and you end up at $3.52. So this is a very strong growing business. They're returning capital to shareholders because they're not capital intensive. I'm very attracted to this business based upon this 5-minute overview. So that basically captures what I need to see here. You could get additional information from the income statement. We can see about dilution. So we begin at 643 shares and you end at 635. So they're not diluting you. That's a positive. And in fact, the diluted shares have gotten even better, going from 727 down to 646. So they're buying back shares, they're paying out growing dividends, and the net income has over doubled in the last 10 years. Very good sign. Balance sheet doesn't really matter because we know that this is not a capital intensive business, but they do have some long-term debt, but basically nothing in comparison to their actual business because it's not capital intensive. Cash flow statement. Again, we see stock-based compensation. So their big expense is people. You can do some additional work on removing some of the stock-based compensation from cash flow from operations, but they're spending relatively low money on property, plant, and equipment, and a lot of money buying back shares. They buy back shares every single year. That's a good sign. And then they're paying money every single year to give out dividends. So thank you for listening to this episode. If you want more, don't forget to like this video and subscribe to the channel. And if you hit that bell, you'll get notifications when I upload new videos. Thank you.